Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking time out of your busy day and spending it with us. Wow, I guess all of us have been through so much volatility, so much uncertainty over the past week. Really, I guess since the end of last week and over the weekend and even till today, we've seen or we've heard the talk about tariffs, 25% tariffs by the United States being placed on all goods coming from Canada into the United States, 25% tariffs on Mexican goods, 10% tariffs on Chinese goods. And in the end, it looks like we've been able to avoid that, at least temporarily here in Canada and in Mexico. Looks like the Chinese tariffs did go through, but there's just so much uncertainty, so many questions that individual investors have. And I guess not much better time than now to have a show like ours today to answer all of these questions. And let's put up our topics for our show this afternoon. We're going to talk about tariffs and how they are currently postponed. What is a tariff? I've been getting a lot of questions on, exactly what a tariff is. Some people are saying tariffs, oh, that means people aren't going to buy our goods. Well, that's not necessarily true. It just means our goods are going to be more expensive. Is there a new normal? This is an interview that I had the pleasure of doing with Jeff Rubin. Some of you might recognize that name. Jeff Rubin was the chief economist for CIBC World Markets for 17 years, from 1992 to 2009. Jeff, a great guest, very knowledgeable chief economist. And what better time to speak to Jeff about the new normal, as he calls it, that the world is in right now, to discuss tariffs, to discuss the economy in Ontario and in Canada, and get his thoughts on that. So a great interview. We're going to have that for you this afternoon, and hopefully most of you can take away something from it. Top 3 things to consider before you make your investment decisions over the next 5 to 10 business days. As always, coming up with 3 ideas that you should be focused on before you buy something for your portfolio. How do you think the markets performed in January? And the reason why I bring that up is there's been so much negativity out there, so much negative sentiment, that when I ask somebody, how do you think the markets performed in January? Most people either don't know, or they think, well, I think the market's probably to the downside. That's actually not correct. The market actually had a fantastic January. We'll touch on that. Central banks going in different directions. And I guess what I mean by that mostly is the direction that the Bank of Canada is taking versus the Federal Reserve in the US. But we'll also show you some of the other central banks around the world who's cutting rates, by how much in comparison to the US. Japan is actually raising rates right now. They're the only central bank that I know of that's actually raising interest rates for the moment. Quick hits. That's the part of our show where we touch on 3 things that you may have seen in the news, heard about in the news, and I'll comment on all 3. Last but definitely not least, your questions. Want to touch on or get to as many of your questions as possible. So if any of you have any questions throughout the course of the show, either regarding the interview that took place with Jeff Rubin late last week, I was able to catch up with Jeff. Any questions about that or anything else on our show today, please put them in the chat box. Be happy to pick those up and answer them on our show today. And if not, hopefully get to them on our next show. So without further ado, let's move on with the show. Tariffs postponed. That is the, I guess, the title for this segment. And again, just to reiterate, United States announced 25% tariffs on Canadian goods and coming into the United States. That was to take place on or go through as of February the 4th. And on Monday, the 3rd, we got the news that, I guess, initially that Mexico had struck a deal to delay tariffs for at least 30 days. And many of us were wondering if Canada would work out a similar deal. And yes, indeed, we did. And the agreement simply was to create what I guess is called a fentanyl czar. The President of the United States, President Trump, is very concerned about the amount of fentanyl drug moving across the border from Canada into the United States, unfortunately causing a lot of death in the U.S., fentanyl and overdose, etc. And so the president is very concerned about that. He's also concerned about illegal immigration coming in from our country. He also made mention about the deficit between the two countries. So there were a lot of things that were spoken about. And in the end, Prime Minister Trudeau has agreed to put some troops on the border. As much as 10,000 troops will patrol our border with the U.S. to help stem the tide of two things: fentanyl crossing the border, as well as illegal immigration. And there will be an appointment of a fentanyl czar who will oversee and be the liaison between Canada and the U.S. So all avoided for now. But of course, in roughly or just under 30 days' time, we may have to go through a bunch of volatility once again. Obviously, the hope is that we'll be able to come to some agreement with the United States to avoid any tariffs being placed on our goods. Wanted to just touch briefly on what exactly a tariff is. A bunch of questions came up recently, and kind of got the feeling that many people, sort of know what tariffs are, but they weren't exactly sure. Our first, diagram or chart, picture, if you want to call it. What is a tariff? And what is a tariff? Well, a tariff is a tax imposed on foreign-made goods paid by the importing business to its home country's government. Like all taxes, they provide a modest source of government revenue. Several countries have also used tariffs to help fledgling industry, so small or I guess industry in its early stages, at home, hoping to shelter local firms from foreign competitors. Some tariffs are also meant to address unfair practices that other countries have used to make their exports artificially cheap. And I guess that last part could be, a good description from a China standpoint. Obviously, when you buy goods coming from China, their labor tends to be a lot cheaper than the labor here in North America and other places around the world, and therefore they're able to make goods a lot cheaper, and that is the main reason. So that's what a tariff is, and so it doesn't mean that if there is a tariff on Canadian goods that U.S. Consumers cannot buy our goods. It just means that the government will put an extra 25% on the cost of those goods, hoping that the U.S. consumer, instead of paying an extra 25%, will buy something made in the U.S. that doesn't have the tariff, that hopefully will be more attractive or cheaper to the consumer. And that's really what this is all about. And there's been some back and forth who actually will pick up that tariff, who's going to end up swallowing the higher cost of that. Is it going to be the company bringing in the goods, the company exporting? Is it going to be the country? Who is going to cover that tariff? And I think it's President Trump seems to think that it would be the company in Canada that would swallow that cost, or Canada in general would swallow these costs. But everybody knows that that's not the case. In many instances, it's the business that's importing the goods that ends up covering that cost to make it more affordable for the consumer. We have another chart here talking about Trump's new tariffs targeting major exporters to the United States. And you can see here, China, Mexico, and Canada, the three largest exporters to the United States. And you can see basically how much these countries export to the U.S. and how important, or how perhaps difficult it would be for the U.S. to put tariffs on these three countries. We've already seen the U.S. putting tariffs on China. They seem to be able to handle that. And in fact, China has already retaliated with their own tariffs on U.S. goods going into China. So that has actually gone through and taken place. But many believe that a tariff on Canadian goods would hurt many industries, such as the automotive industry, and what's going to happen in Michigan with how much the automobile industry makes up of Michigan growth and GDP, and how difficult it would be for the auto industry, because as we know, to build a car, there are many parts that go into building a car, and how many times those parts cross the border between the United States and Canada, and every time it does, are they going to be hit with a 25% tariff? That's just one area. The other things that we saw come up: alcohol. Ontario is a very large purchaser of alcohol from the U.S., and the Premier Doug Ford has said that if the tariffs go through, he will no longer allow U.S. alcohol to be sold on the shelves at the LCBO. And we've seen other provinces as well, BC, as an example, do something similar. We've also heard boycotts of U.S. Business, U.S. companies not being able to bid on certain infrastructure projects in Ontario. So there was a lot going on, a lot of back and forth, a lot of uncertainty. And of course, the market did not like that. And we saw the effects on the market, and we saw the effects on all of us being quite negative. So the good news is at this point in time, tariffs have been postponed for 30 days. The market has definitely regained a lot of its losses, actually, all of its losses that we saw right off the top on Monday. And the hope for the markets and the hope for all of us that we can come to some agreement with the United States to avoid tariffs coming into play at the end of January, at the end of February, beginning of March. So we'll see what the demands are from the United States, from President Trump. He may throw in a few new ideas and new demands, which I think many of us are expecting, but hopefully cooler heads can prevail and we can avoid a tariff. So now I want to get to the part of our show today where we will have an interview with Jeff Rubin, and he's going to be talking on a lot of these ideas, tariffs, the economy, and give us a glimpse as to what he is thinking. The dollar, another one that he touches on, and I think a lot of you will get a lot from his interview, and I look forward, I guess, to showing you this interview right now. To welcome Jeff Rubin, an award-winning economist, energy trade and financial markets expert, and best-selling author to our show. Jeff was chief economist at CIBC World Markets for almost 2 decades, from 1992 to 2009, where he received 10 citations as Canada's top-ranked financial market economist. Since leaving CIBC, Jeff has become a public speaker, written several best-selling books. This past spring, he released his 5th book, A Map of the New Normal: How Inflation, War, and Sanctions Will Change Your World Forever. I want to welcome to our show, Jeff Rubin. Hello, Jeff. Thanks for joining our show.
My pleasure.
Excellent, excellent. And, as always, I like to have a general conversation, and it's not always where we get an economist on our show, so it's fantastic to have you, someone who is, I guess, an expert in trade at this point in time, when all we seem to be talking about is trade between the United States and our country, Canada. So great to have you on. Thank you again. And I thought we'd start off by talking generally speaking about the Canadian economy, and wanted to get your perspective on where we stand right now. There's so many moving parts for the Bank of Canada, and for our government and investors to consider. So many concerns: inflation, tariffs, interest rates, geopolitics. I guess my first question to you would be, at this point in time, what sort of grade would you give the Canadian economy, and how does that, I guess, rate, or in comparison to our neighbors to the south, what kind of grade would you give the U.S. at this point in time?
Well, grade, I guess maybe like a B. I think, we haven't yet seen the final numbers from last year, but it'll be around 2.5%, which isn't spectacular, but could be a lot worse. The latest month, we've had a dip in GDP, but you wouldn't want to hang your hat on one monthly GDP number. But whatever grade you want to give it, it's going to be downgraded, and it's going to be downgraded quite significantly, because exports to the United States is, 20-25% of Canada's GDP. And, that's going to have a very material impact.
And so I guess obviously exports from us to them will be an issue with regards to tariffs. What about the U.S.? Will it have the same impact on them, or to a lesser extent an impact? And how has the U.S. economy fared? I know when we compare the two economies, obviously the U.S. has a much better growth numbers. Their economy seems to be doing a lot better, whether it's because of technology, whether it's because, for any reasons, perhaps interest rates. What do you see? How is their economy doing in comparison to ours?
Their economy is doing stronger than ours. Of course, going with that is inflation is a bit more of a concern there, and certainly very different postures between the Bank of Canada and the Federal Reserve Board. But that's looking backward. Let's look forward. Canada will retaliate, and so they should. But let's be perfectly clear here. We are going to lose in any protracted tariff war with the United States. And we're going to lose for one simple reason. Exports are about 3 times more important to the Canadian economy than they are to the US economy. And 3/4 of our exports are to the US. That's not to say that there won't be local pain in the US. For example, there's like around 15 states. Their number one trading partner is Ontario. Okay. But in the aggregate, nationally, the Canadian economy is a much more trade dependent economy than the US economy. So, in any protracted tariff war, there's going to be more damage in Canada than in the US. That's not to say that we shouldn't retaliate dollar for dollar, because this shouldn't just be a free ride for President Trump. But it is to say that, it's not a long run solution. Our problem is that our greatest asset, reliance on the largest and richest market in the world, has now become a major liability. And, we're going to have to take a page out of some of the countries that have been targeted by sanctions, like Russia and China, who have diversified their trade. And that's why they've been able to absorb these sanctions with relative ease. And that's what we've got to do. It's not something that we can do overnight, but the sooner we start, the better off we'll be.
Yeah, it's interesting. We definitely there's been a lot of talk about changing the way we I guess deal with the United States and perhaps diversifying, our trade a lot more. I guess my next question is, what can we do here in Canada to get things moving in a more of a positive direction? We see the economic data, we see, GDP growth. It hasn't been too high, kind of it's been running just above the flat line for a while. Is the answer just simply to continue to cut interest rates? I know the Bank of Canada has taken on an aggressive stance and just seems to be cutting rates at every meeting. Is it as simple as just keep cutting interest rates until they become stimulative?
Well, if we want to have a 50-cent Canadian dollar, they should just keep on doing what they're doing. It's been my experience 2 decades on Bay Street, that when Canadian interest rates are below US interest rates, the Canadian dollar has only one direction to go. And if you look at interest rate differentials right now, I mean, if you want to compare the bank rate with the Fed funds, you're talking about, 3% versus over 4%. If you want to talk about a 10-year treasury, you're talking 4.5, 4.6 versus 3.3. If we keep this differentials, the Canadian dollar will continue to depreciate. We've already broken into the 68-cent range. That's a 20-year low, and there won't be any bottom. Now, if the grand plan here is, let's have a 25% depreciation in the Canadian dollar to offset the 25% tariff that we expect Trump to impose, yes, that would be an offset. But, do we really want to have a 50-cent Canadian dollar? Because that's what a 25% depreciation from today's levels would imply.
Yeah, and I guess over the last year or so, I've definitely called into question Tiff Macklem and the Bank of Canada and what they've been doing. And you have to, I guess, question it, to raise rates 10 times or whatever it was in a short period, and now to cut rates just as quick. you know, are we wrong to perhaps question as the thoughts of Tiff Macklin and what the Bank of Canada is doing? Do you think they're doing a good job and they're on the right path?
Well, not to get into the personalities, but bigger picture. The issue, as I write in my book, is the problem is no one knows what normal looks like in the bond market anymore. And that's a legacy of the pandemic. I mean, we had overnight rates at zero. We had 10-year government bond yields at 0.5%. By some account, the lowest long-term interest rates have been in recorded history. So is that the benchmark? Sure, we had a huge run up in interest rates from those absurdly low rates because the Tiff Macklams of the world were buying the Chrystia Freeland's bonds at ridiculously low yields and ridiculously high prices, and the same ditto for the Fed and the European Union. But that's the problem. No one really knows what normal is. I think this world that we're heading into is an inflationary world. And if it's an inflationary world, then I don't think today's interest rates reflect that. And it won't matter whether President Trump fires, the Fed chair. The bond market will decide unless Trump wants to start ramping up the printing presses and go back to quantitative easing. And I would argue that today's long-term interest rates are not well calibrated with the reality of where inflation is heading.
Let's turn now to the stock market. Obviously, we are a financial show, and a lot of people listen to us for tips or commentary on the stock market. Obviously, North American markets in particular. Many would say the valuations are stretched, right? That when you look at it on a PE multiple, things look stretched. It's quite expensive. Do you agree? And if you do not agree, or perhaps you do agree, but do you still see value anywhere in the markets? Obviously, the markets are being led by technology. Do you still see any value out there?
Well, what's the alternative? Buying, a government bond at below 3%. And, it's real easy for the stock market to do well when bond yields are plunging. It's a little more challenging to swim upstream against rising bond yields, and that would also include AI stocks. And I think that's the real challenge from the stock market, that I don't think the market yet recognizes what kind of comeback inflation's about to pose. And, when we got a yield curve, we had the longest inversion of the yield curve in history. We've got basically a flat yield curve if you look at sort of like a 10-year Government of Canada bond versus the overnight rate. That's not sustainable, in my opinion. And it doesn't matter what the Bank of Canada or the Federal Reserve Board does. We go back to a normal shaped yield curve, and you're looking at 100, 150 basis point rise in bond yields. Let's see how resilient the equity market will be swimming against that current.
You mentioned artificial intelligence. Do you think big cap tech is going to lead the way this year again? Obviously, we've had now 2 years in a row where big cap tech has led the way. In my
That's right.
opinion, we were
They
headed
have.
for a recession, and I think if not for AI and the talk of Chat GPT and everything around it, we probably would have been in a mild recession a few years ago. So, do you think tech is going to continue to lead?
Well, one thing about tech is America's supposed dominance isn't as great as we've been led to believe. And we saw that with NVIDIA, Deep Six, all of a sudden, Seek, all of a sudden a Chinese firm that can do this at a fraction of the cost. So there's that issue. And there's no question that of any aspect of the stock market, the one that has benefited the most from these, very low bond yields has been AI. But as I say, I'm skeptical that the curve is going to remain distorted as it is. I think we're going to see a steepening yield curve, and I think all of the stock market, but in particularly tech stocks, are going to find it a lot more difficult, as I say, swimming against the current.
Swimming against the current. Yeah, no, for sure. As I said off the top of the show, great to have you on now at this time, being a trade expert. So let's turn to everyone's favorite topic these days, tariffs. I guess my question to you would be, you know, wanted to ask you about the idea of tariffs, putting on tariffs. Uh, can they be successfully used? And, are they a great tool for negotiating?
Well, in this case, I have to agree with President Trump. They can be very effective. But let's understand what tariffs are going to do. They're going to reverse the trade-off that we made for decades through globalization, which was sacrificing middle-class factory jobs for low inflation, and consumers certainly benefited from that. Tariffs turn that around. They're already bringing back manufacturing jobs that we thought were gone forever. But everything that we're going to make here that we used to import from places like China is going to cost us a whole lot more, whether it's, a computer chip or a kettle or a car. So that's the trade-off that we're making. It's good news for the subject of my previous book, The Expendables, like the hollowed out middle class. They're coming back. It's bad news for inflation. So it really depends on what you think is more important. Now, President Trump has said for decades, actually, he's been against, globalization and the World Trade Organization's trading rules. And he's championing the American working class, and they will benefit. But not, the American working class will benefit, but American consumers will pay the price for that.
Interesting trade-off. Well, just the thought of tariffs, right, has caused our dollar to fall substantially. Obviously, the Bank of Canada keeps cutting interest rates, and you mentioned earlier in our interview about a weakening dollar. Do you think that a weakened dollar can offset some of the tariff pressures that we're going to see, or does the dollar have to fall a lot more for that to be a factor?
Well, it can. I mean, one of the ways that China has responded to tariffs, and remember that Trump imposed these huge tariffs against China in his first term, was a depreciation of the yuan. So, yes, the Canadian dollar can offset. But, a 25% depreciation from today's levels to counter a 25% tariff would imply a 50-cent Canadian dollar. What are the inflationary implications of a 50-cent Canadian dollar, particularly at this time of year when so much of our fresh produce is imported from the United States? I think we would immediately see that in grocery prices and food inflation, and not to mention the cost of travel. And there's more than a few snowbirds in this country. So, yes, but we would be talking about the Canadian dollar needing to go into a realm that it's never gone before.
Yeah, it's you know sad to see our dollar as low as it is, even today at in the 68-cent range. I guess last time we saw that was I think 2020 when COVID hit, and then prior to that, probably a little while. I want to turn to your book now, and you've written a number of great books in the past. I want to read out just some of the ideas and themes of your latest book, A Map of the New Normal. You talk about a changing world, the change in global trade after the pandemic, a rise in government deficits, new emerging order with the rise of sanctions, moving from offshoring to friendshoring, what that means, dealing with your friends versus your enemies, and the potential rise of the BRICS. So much in the book. There are so many great ideas and themes. I guess my question to you and everyone listening and watching, what made you write this book and put in all these ideas? And I guess what is the main takeaway that you would want from the readers?
Well, I guess the main takeaway is it's tempting to think that, Donald Trump is a black swan. This is an aberration, and if we can ride out the next 4 years, we'll go back. There's no going back. Okay, there's the old world that now seems, way in the rearview mirror, it doesn't exist anymore. In fact, it didn't even exist under President Biden with sanctions. We're in a whole new reality. So, the world trading system of the last 30, 40 years that we were constantly told was the basis of our collective prosperity, it no longer exists. And this is a whole new normal.
Interesting. Perhaps a bit of a scary message
Oh, it is what it is.
for
As I
many.
say,
Yeah.
like for American workers, this is a reprise that they never could have dreamt for. But, it's going to change the way our economy operates, and that's going to create winners, and that's going to create losers, just as the old world trading system did.
Yeah, and I guess my last question, what do you think about the comments from the president talking to the BRIC nations that if they don't use the US dollar, they're going to just be hit with 100% tariffs? Do you think that can actually work? Can he continue to I guess, scare or threaten these countries?
No, he can't. China is not Canada. Okay. They'll go bring it on. Now, the US has already lost its status as the world's petrol currency, a status that it enjoyed for over 50 years. And we can thank Biden's sanctions and the response of Russia and China and Saudi Arabia to that. But there's more at stake. The US, since World War II, has been the world's one and only reserve currency. Guess what? China has other ideas about that. And, I'm not saying that the US dollar is going to lose that status, but it's going to be challenged in a way that it hasn't since during the post-war period.
Jeff Rubin, award-winning economist, best-selling author. Thank you so much for being with us this afternoon. It's been a pleasure having you on and shedding some light on everything that's going on right now, the economy, what's happening between US and Canada. Much appreciated. Thank you so much.
My pleasure. Hope to be back again sometime.
Thank you. What a great interview that was. And keep in mind, I spoke to Jeff Rubin prior to obviously this beginning of this week when Canada made a deal with the US to postpone tariffs. The time we were speaking, tariffs were right up against it. We were right up against the deadline, which was February 4th. And we did not know yet that there would be a deal made. And I guess where we sit today, we've just postponed things. It does not mean that tariffs will not be placed on Canada, I guess, at the end of the month. So everything that we spoke about definitely applies. Just a great guest, so knowledgeable, and definitely want to take a look at his books, his latest book, A New Normal, and his previous books. Just a wealth of knowledge there. Now we come to the part of the show where I talk about three things that I think individual investors need to focus on before you make your investment decisions. You can see them already on the up on the screen. We have Trump announcements. Now that is pretty self-explanatory. Anything that comes out of the president's mouth over the last since he came into power, since he was elected, tends to move markets and move markets by quite a bit. And the last few days is definitely no exception. Jobs data. Jobs numbers are out on Friday in a couple of days. What will the jobs numbers tell us? Obviously, we're very sensitive to inflation, especially inflation in the US, where that seems to be a bit more of an issue than it is here in Canada, with Canadian inflation numbers in and around 2%, just below it right now. US actually moving more towards 3%. What is the jobs data going to tell us? What message will that give individual investors? The third point, stock misses, understanding the reason behind the way a stock moves. And that could be stock misses or even stock gains when stocks actually exceed expectations. Why is a stock moving? Everybody has to do their homework. There's no doubt about that. Sometimes the headline news or the headlines will say something positive, and yet the stock goes down. And sometimes the stock will say something negative, and the stock goes higher. This is all about understanding what's happening underneath the headlines and reading the fine print or reading more about what's happening. So I want to touch on that as well. So let's move on to the first topic, Trump announcements. And our first, I guess, chart tells the story most definitely, right? It shows the currency, our currency. There you have it. And you can see here on February the 2nd, our currency hit pretty much a low that we have not seen in a long, long time, in and around or just above 67 cents. And it stayed that way. It started to move a little bit higher on February the 3rd or Monday, this past Monday, But still, it wasn't until we started to hear of deals perhaps on the table. What first deal came with Mexico, and then a deal with us here in Canada, that our dollar really started to move. We actually saw our dollar, or about $1.48 for every dollar of the US at its low. And then by the end of Monday, we actually saw it back to about $1.44. And today, I can actually tell you before I came on air, our dollar was pretty much back to 70 cents higher than when we went into this past weekend. We have been falling in value. Our currency has been falling in value versus the US dollar because of other things, such as interest rate cuts by Bank of Canada and no cuts or very few cuts out of the Federal Reserve. Also, growth numbers out of the US a lot stronger than our growth numbers. Two main reasons why our dollar has been sort of sliding as we moved into these tariff or trade negotiations. And then once it was announced that 25% tariffs would come on Canadian goods, while our dollar just sank even further down to just above 67 cents. And as I said, has since moved back to 70 cents per versus the US dollar, and higher than where it was heading into this past weekend. So you can see how just by commentary out of the president, President Trump, it definitely moves markets. It definitely moved the currency market. Let's take a look at the S&P 500. The S&P 500, you can see here a pretty big dip on February the 3rd. Once again, that was when the talk that tariffs were coming the next day on the 4th, and that there was nothing, according to the president, that Canada could do. We were going to have 25% tariffs on our goods. And the president made very clear that there was nothing we could do. And then, lo and behold, negotiations, a couple of phone calls, and we get a reprieve. We get, I guess, as I said recently, a stay of execution for another 30 days. And hopefully that day does not come. And as I said, negotiations can happen, and we can avoid tariffs on Canadian goods. So to me, that's really what can happen when the president talks about, mentions tariffs, mentions anything. It could be anything from interest rates should be going down to tariffs need to be levied. It could be talk about Canada. It could be, recently he talked about the Eurozone and how the U.S. has a pretty large deficit with the European countries, and that tariffs need to go on their goods as well. We saw how that affected the Eurozone pretty quickly as well. So it just seems like no matter who we are, no matter where you are in the world, if you're an investor, you need to be focusing on what is coming out of Washington and what is coming out of the Oval Office in particular. Second point that I think individual investors should focus on, as I mentioned, are the jobs data. Is the jobs data coming out this Friday? The job market has been pretty strong, both in Canada and in the US. Both numbers will be released on Friday. Our first chart here shows job creation in the US. You can see that 256,000 jobs created month of December. How did January fare? Well, expectations are for a number coming in less than 200,000. We'll see how that works out. Obviously, strong jobs data will lead to perhaps inflationary pressures, and that's not something that the Federal Reserve wants to see. Our next chart shows the U.S. Consumer Price Index, CPI. You can see here that it's actually starting to tick a little bit higher, more towards 3%. Headline number got down to 2.5%, today at 2.9. And actually the core CPI, or the number that we look at, which takes out volatile food and energy, that actually fell from 3.3 to 3.2. So you can actually see those two numbers kind of getting a lot closer, but definitely something that the Fed is watching. Our next chart shows Canadian employment, and you can see how strong our data was. 91,000 jobs created. That would equate to something like 900,000 jobs created in the United States. They have 10 times the population that we do. So a very strong number out of Canada, something that definitely wasn't expected. But you could see the month before 51,000, 2 months before that 47,000. So numbers on jobs have been very strong. And you can see how, once again, our inflation rate looks as compared to our Bank of Canada rate, which is our next chart here. And you can see that, of course, our inflation rate coming in just under 2%, as I mentioned. Most people believe that if we are not in this GST holiday, which is going to last, I think, another week or so. But if we weren't in this tax holiday, we would probably have seen an inflation rate closer to 2.3%. Our bank rate sits at 3% with the most recent interest rate cut that we saw this past week, or last week, I should say. And again, the expectation is for more cuts to come. And what will that do to our currency is the question. So again, you have to be looking at the jobs data, all the economic data, whether it's CPI, whether it's PCE, retail sales, any kind of data that is going to get released by the United States and Canada. It's very important how central banks look at this data to set interest rate policy to hopefully, in the US especially, bring down the inflation rate closer to their 2% mandate. The third point that I want individual investors to focus on, as I mentioned, is this idea of understanding stocks and basically not just looking at the headline of the stock, but understanding what's going on underneath. Why is a stock moving higher after they report earnings? Why is a stock perhaps falling after they report earnings as well? And I have a few charts of a couple of names here that just reported earnings. The first chart being Alphabet, formerly known as Google. And you can see that the stock has had a great run up into the earnings, but I can tell you that they reported earnings just yesterday. Stock was down 7%. And people are wondering, what has happened? Why is the stock down? Well, they beat on the bottom line on an earnings per share basis, but their top line revenues came in slightly soft. But many people will say, well, that's not a reason to see the stock fall as much as it did. Well, I can also tell you that if you delve into the numbers closer, you'll see that Google or Alphabet is spending a lot more money on AI. $75 billion they're going to be spending on AI. A lot more than what people anticipated. Most investors anticipated maybe 55, 60 billion. They're doing well above that. And lastly, even though they grew their cloud business by 30%, it was down from 35% that they grew their cloud business the last quarter. So some negativity there that the market focused on. But once again, if you were not looking into the data or the report that came out when they reported earnings, you wouldn't have known that as an individual investor. Another name, AMD, reported as well last night. Their numbers were fantastic. They made their top line number, revenue number, their EPS, earnings per share number. They actually had record revenues for the fourth quarter, record. So they never had revenues like this ever. Yet their stock was down, or as you can see, it's still down this morning about 10, 11%. Why is that? Well, their data centers, where their bread and butter, so to speak, is their AI business. Their data center business was below expectations. It did not grow as much as people wanted to see it grow. And still, till this day, NVIDIA seems to be dominating in the AI space. And doesn't seem like AMD can get a whole lot of traction there. There's talk that companies like Amazon are buying their chips. They like their chips. Their chips are effective, powerful, cheaper than NVIDIA chips, but just doesn't seem to gain the traction that individual investors want quick enough anyways. And we're seeing a decline in the stock actually today by 10% as I came on air. Another stock, Microsoft. Microsoft had great earnings, beat on the top and bottom line. You can see it here. You can see how Microsoft has been trading quite choppy, but their biggest problem was also cloud business, the Azure cloud space. 33% growth last quarter, this quarter 30% as well. Very similar to Google. So is this company specific or was this really industry specific that we're seeing cloud business slow down? And Microsoft sold off on those numbers as well earlier this week. On the flip side, Tesla. We have a chart of Tesla here. Tesla has been really rolling since President Trump was elected, inauguration, and Elon Musk joined his team in Doge, I guess the government or part of the government looking for efficiencies to cut costs for the government. And but Tesla reported earnings. They actually missed on the top and bottom line. So you would have thought their stock would fall. No, it didn't. Stock of Tesla actually went higher on the earnings report. And why is that? Well, simply because the talk of robo-taxis was front and center. and this idea of having a taxi pick you up with no one sitting inside, obviously a Tesla vehicle, picking you up and taking you to where you want to be, looks to be already happening in certain parts of the United States, but Tesla is making that a reality as well, and it's coming sooner rather than later. Apple is a company that, our last company that I wanted to highlight, again, talking about how, I guess, weak their performance was in China. With that in mind, you would have thought Apple would have had a difficult time. As you can see here, stock went up 2%, and that's because their services business had a very good quarter. So even though Apple is growing by mid-single digits with a PE multiple of over 30 on a forward-looking basis, so very expensive, stock went higher. So you look at a headline number, you would have thought Apple stock would have fallen. No, that was not the case. So for individual investors, before you make your investment decisions, I think it's really important when these companies report earnings, not to just look at the headline number, but also delve into the earnings, to see what they are saying, tell the story, read about the story behind the earnings. And that to me will give you the best indication on whether a company is worth owning their stock or not. And you couple that with keeping one eye on the politics, it's coming out of Washington, the economic data, jobs, sales, GDP. And I think those are the three things right now that individual investors should be focusing on before you make your investment decisions. So how did January perform? For most people, if I ask that question, they would think, well, it probably was okay, didn't probably perform that well. And that's because everybody seems to have a bit of a negative outlook right now. Things seem a little negative. We have a prime minister that just resigned. We have an election going on in Ontario. We have the president of the United States possibly putting 25% tariffs on goods going into his country from Canada. The United States is our largest trading partner. 70% of what we pull out of the ground and build goes to the United States, exports to the United States. So things just didn't seem so good. And I definitely received many indications of that. Received a lot of emails. Allan, should we be selling some stuff out of our portfolio in preparation for a market that's going down? In preparation of tariffs, I'm getting nervous. I'm getting concerned. These were the comments I received from individual investors. Well, can I tell you? January was a great month for the stock market. Even though the negativity was everywhere, TSX was higher by over 3%. S&P 500 was higher by around 2.7%. So things were good. The NASDAQ, technology, very sensitive to a lot of things that is going on. Even technology or the NASDAQ was higher by 1-2%. So the main message I want to give to all of you listening today or watching today is sometimes things seem a lot worse than they actually are. The market is able to climb that wall of worry on a regular basis. If you always wait for there to be blue sky, no storm clouds out there, then you're going to wait a long time because there are always storm clouds on the horizon. And at the end of the day, it's all about what investors in the markets decide to focus on. And that's how the markets move. Sometimes they'll focus on something that you may think is insignificant. And sometimes what is significant to certain people, the market won't seem to focus on, or they'll put less emphasis on that. So you really can never tell what's going to happen. But to me, the recipe for success has always been to buy good quality investments, buy them at good values, and if you can buy something with a dividend, it is always a good idea. A couple of charts I have for this segment, S&P TSX, our first chart. You can see here that spike up. That was the month of January. Things got a little bit, I guess, negative at the start of February, and we saw the TSX come down a bit. But I can tell you, it has rebounded in the last few days. Next chart we have here is the S&P 500 chart, and you can see how that performed. And again, looking at January, towards the end of January, things kind of spiked. Then towards the beginning of February, things came down. So a good month for the S&P 500, maybe not as good as the TSX or the Toronto markets, which is unusual for me to say that the Canadian market actually outperformed the US, but it happened. And overall, I just want to make the message or give the message to everybody that the market can do well, even in times of volatility and in times where we think there are crises out there. The market is able to climb that wall of worry And so you don't want to panic sell. You don't want to make any moves with your portfolio and panic. You want to stay the course, continue to buy good investments through good and volatile or bad times. And that is the best way, in my opinion, to move ahead and grow your portfolio over time. Central banks are definitely going in a different direction. And as we talk about on a regular basis, our bank seems to be very quick to cut, try and stimulate the economy here in Canada, whereas the US economy seems to be doing just fine. The Fed is in no hurry to cut rates. And that has obviously caused some discrepancy in our dollar. We've seen our dollar fall below 70 cents most recently. And for many people that believe the Bank of Canada will continue to cut interest rates, that our dollar probably won't get much higher from here, at least for a little while as yet, until we start to see US rates come in line more so with Canadian rates. And Jeff Rubin made mention of that as well. A chart that we have here showing, I guess, changes in policy rates of 10 major developed countries. You can see here, as I mentioned off top of the show or earlier in the show, Japan is the only, excuse me, only economy actually raising interest rates. You can see them on the bottom there. Canada is right in the middle. They have cut basically 200 basis points or 2 full percentage points of cuts in the last, let's call it 7-8 months or so. And as I said, that looks to continue. You can see what the UK has done. Even the US has cut. Norway, Australia, kind of no cuts there. New Zealand has cut. Canada, big cuts. Eurozone has cut as well. And if we go to just Bank of Canada and the central bank, and what we've seen in terms of bank cuts, you can see how many cuts the Bank of Canada has made in the last, as I said, just over 6, 7, 8 months. Bank of Policy interest rate cuts, you'll see here. You can put that up. There it is. You can see starting in June, we had 3/4 point cuts in a row, followed by 250 basis point cuts, and then a 1/4 point cut this past month in January. Compare that to the United States, which is our next chart. You can see they have cut, but you can see how little they've cut, down to 4.5%, 4.25%, 4.5% range. And you can see definitely because of that reason, it's affected things such as our dollar. And for many people, they're just finding it difficult to figure out when our dollar will actually get back to 73, 74, 75 cents. I don't anticipate that range anytime soon. If our bank continues to cut while the US stands pat, I see no reason for our dollar to gain strength. The last thing I will say about the currency is that hopefully our Bank of Canada cutting as many times as they have and as they may do in the future, I hope that our dollar doesn't fall too far where it actually starts to cause inflation to rise here in our country. So definitely two banks, Bank of Canada, Federal Reserve, definitely diverging in terms of how they're handling the current monetary policy. And I would say that will probably continue in the months ahead. Our quick hits, 3 topics that I wanted to just touch on briefly that came up over the last couple of weeks that some of you may have seen. First one, US fourth quarter 2024 grew only 2.3%, less than expected. Is it a cause for concern for the US, or is it maybe just a bit of a pullback? We'll touch on that. Trump sets up sovereign wealth fund to buy perhaps TikTok. We have a number of countries around the world, a couple of areas around the world as well, that set up this sovereign wealth fund. And basically what that is the country puts aside some money to make investment. And some are thinking that maybe if the United States does this, then maybe they could actually buy TikTok themselves. Third quick hit, central banks urged to revamp interest rate setting policies. We saw how slow central banks were to start to raise interest rates. Inflation was rearing its ugly head for a long time before central banks started to raise interest rates. Central banks were saying, oh, it's okay. Inflation is transitory. It's something that is popping up and it's basically temporary and it'll go away over time. Well, that did not happen and central banks had to raise rates very quickly. Let's go to our first quick hit. The US Q4 grew at 2.3%. Our first chart here, we can see how the quarterly results have fared. 2.3% is the lowest since the first quarter of the year. However, when you look at it, I'm not panicking, or I don't think anybody should panic based on 2.3%. If you take a look at the year in total, you're looking at a growth rate of 2.8%. And our first quarter GDP in the US is actually looking even stronger than that for this coming quarter, or for this year, first quarter 2025. So anyone reading about 2.3%, oh, maybe things are slowing down, maybe the consumer is slowing down, I don't think that's the case. I think that it is just a bit of a blip down from what we're used to seeing. If you go back to the third quarter three of 2023, you can see almost 4.5%. Wow, that was a pretty large number. Second quick hit, wanted to just briefly touch on, was President Trump sets up a foreign sovereign, or a sovereign wealth fund. And again, as I mentioned, this is a fund where money is contributed to, and this is used to make buys. And we've seen other very large sovereign wealth funds around the world making buys or making investments, such as the Saudi Arabia wealth fund, making big investments in the United States, announcing $600 billion in investment in the US. We have a chart here on the largest sovereign wealth funds in the world. And many of you probably wouldn't know that Norway Government Pension Fund is the biggest, followed by China Investment Corporation. There you have Abu Dhabi Investment Authority. So Kuwait down towards the bottom there. So these are investment funds that are built and created to make investment for the country. And many believe that maybe President Trump is starting one in the United States to perhaps buy TikTok. We'll have to see. Time will tell. Our third quick hit is this idea about central banks, and they've been urged to revamp interest rate setting policy. The Bank for International Settlements is urging central banks to revamp how they see interest rates. They believe that interest rates were kept too low for too long, and they created the issue with regards to inflation. And then we went through the pandemic. We spent a lot of money here in Canada and the US, and that just made the situation even worse. So the Bank for International Settlements is saying you need to look at your interest rate setting policy, how you set policy, and revamp it to be more modern in terms of the times that we're seeing today. So those are the three quick hits that I saw, and probably many of you have seen as well in the news. Wanted to make a few comments on them, but overall, to me, it's all about the interesting sovereign wealth fund, how interest rate policy will be set by central banks. These are interesting quick hits that I wanted to discuss today. We had a bit of a long show today. The Jeff Rubin interview that took place last week went a little longer, but I thought some really good information. Got time to take one question that came up, and we'll go with this question. It's kind of has to do, obviously, with the theme of our show today. Policy announcements are coming from the White House very quickly. What is your advice to investors who are scared or alarmed by the changes and unpredictability? Well, we sort of touched on that already. I think you just got to stay the course. I think you got to continue. You have to continue to look at good quality ideas in good times, in bad times, in times such as now, unpredictable times where people are nervous. They don't know where things are going, because we can see how quickly things change. Monday morning, we thought tariffs were being placed on Canadian goods. And by the end of the day, we had a reprieve for 30 days. And hopefully by the end of this month, we will learn that there's a deal between the US and Canada, and tariffs will not happen at all. So anybody who postponed making an investment or putting money to work, perhaps were whipsawed. They were nervous about the markets, and maybe they should have got into the market. Markets are going to be volatile. They're going to continue to be volatile. They never go up in a straight line. But I think if you continue to look for good quality investments that are trading at good values, that is always the recipe for success. So with that, I want to thank everybody for joining us today. I hope all of you took something away from our interview today, from our conversation, our points, our top 3 things to consider before you make your investment decisions. I want to thank you for joining us. And I hope that all of you will tune in 2 weeks' time for our next episode, which will be Wednesday, February the 22nd, again at 12 noon on all, I guess, social media platforms, from YouTube to LinkedIn, Facebook, etc. So until then, I want to wish everybody a good investment climate, and hopefully things get better with respect to what's happening, negotiations between the US and Canada. And until then, and until our next show, happy investing.